All right, stocks are down after the first government shutdown in 7 years. 30 minutes until the start of trading. I'm Matt Miller. Danny Berger is on assignment, but we will be getting to her throughout the program. Bloomberg Open Interest starts right now. Coming up, the U.S. government shuts down for the first time in nearly 7 years, and the third time under the presidency of Donald Trump. Democrats and Republicans showing no signs yet of compromise. Meanwhile, on the data front, a big miss for ADP. Private sector payrolls unexpectedly fall by 32,000 in the last month. And as the risks to the economy rise, stocks kick off the fourth quarter in the red, while gold climbs to yet another record high. In terms of the single stocks that we're watching, Nike is one of them after the company beat expectations, but it did warn that its turnaround will be bumpy as margins remain under pressure. Still, the shares you can see up 4.5% in the pre-market. The U.S. government agreed to acquire a 5% stake in Lithium Americas to help counter China's control of the lithium market. This had been previously reported, but still provides the confirmation a lift of 32%. Now, it is a very small stock, so keep that in mind. And Meta Platforms moving to the downside. The owner of Facebook is going to start using interactions with its AI chatbot to more effectively tailor the content and advertising on its platform. So Meta will be listening to you, and you won't be able to opt out. Now, the main story, of course, President Trump and Democratic leaders pointing the blame on each other as the government shutdown begins, both sides trying to define their priorities ahead of next year's midterm elections.
How many federal workers do you plan to lay off?
Well, we made you a lot, and that's only because of the Democrats. And as you know, they wanted to be able to take care of people that have come into our country illegally, and no system can handle that.
If you want an indication of how serious Republicans are about keeping the government open, who wants the shutdown? There's no better proof than the fact that Speaker Johnson sent everybody home this week, ensuring a shutdown no matter what the Senate did.
For the latest on the shutdown, we're joined by Washington correspondent Tyler Kendall. So, Tyler, in terms of actual services, are we going to see right away? What over the longer run, and how long until this gets solved?
Well, that's a really loaded question, Matt, because at this point we haven't seen any of the sides really move towards an agreement after government funding lapsed early this morning. Now, in terms of what's going to happen, we're going to start to see government services really slowed down. But keep in mind, any of those functions deemed essential will continue to open, such as healthcare agencies, things like that people really do depend on. But importantly, things like the Small Business Administration, for example, that will shutter. National parks are going to close. Permits are going to be slowed. And ultimately, 750,000 federal workers are expected to be furloughed, though expected to get back pay once the government does reopen. But that means that they're going to be without work and without paychecks until that happens. Now, as you well know, at the heart of this is that Democrats are demanding that some policy changes are made now instead of down the road. They're asking for changes related to health care provisions, including extending or making permanent those expiring Obamacare tax credits set to end at the end of this year. Republicans, though, Matt, are pushing forward with what's known as a clean CR, a continuing resolution that would fund the government through mid-November. No other provisions attached. Republicans ultimately need 7 Democrats to get on board with their plan, really 8 if you think about it, because we're not expecting Republican Senator Rand Paul to ultimately vote on any bill that keeps government funding levels where they're at. Last night we saw 3 Democrats get on board, so Matt, that means 5 more need to come over.
All right, Tyler, thanks very much. Tyler Kendall there out of Washington. Now, payrolls at U.S. companies unexpectedly dropped in September, the fall due in part to issues with data analysis. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now to talk first about the ADP numbers, Mike, but also how this shutdown could affect jobs in general.
Yeah, overall, it's going to be a pain for people on Wall Street and for people at the Fed. The problem we have here with ADP is it's normally not considered a reliable indicator to what we get for payrolls. But since we're not getting payrolls on Friday, it looks like then you have to go with ADP. But ADP says it had a sort of problem this month, shall we say. As you mentioned at the top of the show, ADP saw 32,000 jobs, private sector jobs, lost in September, and 3,000 in August, revised down from a gain of 54,000. But they re-benchmarked their numbers to the quarterly census of employment that the BLS puts out, which is the number. Remember, we got the last non-farm payrolls report, 900,000 jobs were lower than in the year before. Well, the government doesn't re-benchmark those until January, but ADP re-benchmarked it this month, and they said it subtracted 43,000 jobs. So you might have had a total of 11,000 if not for that. BLS doesn't re-benchmark by month until January, as I said, so the numbers probably wouldn't be very comparable anyway, and that's a problem for people trying to figure out what all this means in the absence of the payroll numbers. We do have some substitutes you can look at, Matt, and I'm sure you will love this. If you go to WSL ALTE on the Bloomberg terminal, you can get a whole long list of other jobs numbers and indexes put out by various private and government sectors. So just a few of them there. ISM Manufacturing and Services, we're going to get that manufacturing number at the top of the hour, and that'll get a lot of additional scrutiny as well. You also mentioned the table of things that we're going to miss. We're going to miss a lot, not a lot this week. Jobless claims may be the worst of it, but besides payrolls. But long term, if we don't get this done by, say, October 18th, the week that includes the payrolls number on the 12th, you might not get an October jobs report at all. And the same thing might be true of CPI if it goes on for too long. So that would really throw some monkey wrenches into the Fed's ability to tell what's going on with the economy and for the market's ability to bet on what the Fed is going to think.
Yeah, Mike, I see everybody pushing out from a trader buddy of mine, Anthony Santos Stefano, to Torsten Slok, pushing out this Bloomberg function, WSL space ALTE, go, to get alternative sources, which is fascinating. We'll talk to you again at 10 o'clock because, as you mentioned, ISM is coming out, construction spending coming out as well. Michael McKee is our international policy and economics correspondent. Let's bring in Terry Haines now, founder of Pangea Policy. And Terry, just to help me understand exactly what's really happening, to hopefully take some of the political spin away. The Republicans say that they want just to pass a clean CR to keep the government open, and that the Democrats want to add $1.5 trillion of health care funding. Who is holding America hostage here?
Everyone is, Matt. And good morning. Everyone is, because at root, you've got a Congress that hasn't been able to approve full-year spending bills for well over a year now. We've been running on temporary authority for since before the beginning of the Trump presidency. So what you got here is a situation where there's not a lot of leadership going on both sides. What Republicans have the better of the argument right now, though, and I'm not saying this in a partisan way, but it's an easier argument. All the Republicans saying, look, I mean, if you want to negotiate on some stuff, let's just keep the government open and we'll negotiate. But Democrats have a higher bar. Schumer's trying to navigate kind of the money and the energy in the party that are demanding some resistance to the bad orange man, and at the same time, they decided only a couple of weeks ago that they wanted the hill they wanted to die on in this negotiation was health care and really readdressing the cuts that Republicans made in July in the tax bill. So they want to do that, but there's no chance right now that Republicans are going to cave to the Democrats wholesale. But Schumer has also got a win in front of him, which, if he wants it, which is to announce the restart of negotiations and bring the government back in.
I thought it was interesting. I looked back at some of Schumer's comments from 2013 and 2018, 2019 from those shutdowns, and he was saying, like, we can never hold America hostage again. And yet he essentially is holding back most of his party from voting for this CR. On the other hand, President Trump has said that he wants to fire large numbers of workers, almost, it seems like he's saying, as retribution to the Democrats for forcing this shutdown. I thought that was part of the whole plan, shrinking the federal government. Why don't the Republicans take advantage of this and actually do it?
Consistency is the hobgoblin of little minds, Matt. Emerson said that, and he was right as usual. On the federal workers, it's a moving target, and Trump's intentionally making it so. The original was, we're going to fire mass quantities of people. Now they're not talking about firing; they're talking about furloughing, which is even a little fuzzier. But they don't for a couple of reasons. One, they've got to keep the government open, but secondly, it is a pressure point on Democrats. The public employees are mostly unionized, and they are vastly pro-Democrat. So what you've got now is a situation where, to go back to Tyler's point, you got 52 Republicans, you got 3 Democrats that are already voting with the Republicans to reopen the government. That's 55. You need 5 more Democrats. 4 of them happen to be from Maryland and Virginia, which are 2 states that have large number of public employees. The last thing those 4 senators are going to want to see is kind of mass layoffs or furloughs or firings. So there's going to be increasing pressure on Schumer within his own caucus to bring this to an end sooner rather than later, because now you're at 59 and you need 1 more after that.
All right, Terry, really appreciate your time this morning. You're definitely someone who's going to have to work even more as the government shuts down. Terry Haines there of Pangea Policy. Joining me here at the desk now is Citi's head of U.S. equity trading strategy, Stuart Kaiser. And Stuart, great to have you here. The assumption is that equities don't typically care too much about a government shutdown either way. Is that correct?
Yeah, I think that's our working assumption. As Terry kind of alluded to, approval ratings of the U.S. Congress are pretty low to begin with, so I don't think this is really going to surprise a lot of people. From our perspective, for this to be really impactful for equity markets, you're going to need to see it last for a while. You're going to see pretty large layoffs, or you're going to need to see something happen in the bond market to kind of spill over into the equity market. None of those are base case, but I think those are the required type of things you'll need to do to really impact equities.
Is Wall Street sort of operating on the assumption that this only lasts about a week? I mean, as Terry said, you've already got 3 or 4 defectors from the Democratic Party, and it seems like probably more to come.
Yeah, I think that would be the view. I mean, probably weeks, not days, but I don't think we'd expect it to last. Like in 2018, you lasted almost 5 weeks. I don't think the market's expecting it to last that long. But, the fact is, the Democrats were under pressure back in the springtime for not pushing back harder and potentially shutting down the government then. So it does kind of put them under pressure to, I think, not only shut the government down, but kind of let it last a little bit. So it does look like they're resisting, the kind of Trump policy push.
All right, Stuart, you're going to stick with us. My guest co-host for the hour, Stuart Kaiser from Citi. Coming up, Nike earnings aren't as bad as expected. The company realigns the business around specific sports like running and basketball, and we'll dig in to those results ahead. Happening right now in London is Bloomberg's Women, Money, and Power Conference. The event brings together the most influential female voices in global finance to discuss critical themes facing the future of business. That's why my co-host Danny Berger is there, and you can follow along anytime on your terminal. Just type LIVE GO. This is Bloomberg.
What's the level of a social state that I firmly believe in it. I think it's everybody's responsibility to.
Let's get now to high interest. Look what's making headlines around the world. PIMCO says it's time to grab bonds while the yields are still juicy. With central banks chopping rates and cash returns set to sink, the bond giant argues fixed income can beat cash and deliver 5 to 7% portfolio yields. The firm is overweight duration, cautious on corporate credit, and warns that tariffs could chill growth. But bottom line, bonds look like the safer bet than sitting in cash, at least according to PIMCO. Meta is about to mine its chatbot chats to fine-tune what you see on Facebook and Instagram, sites that it owns. Starting December 16th, users may begin to see recommended posts or ads about topics they discuss with the Meta AI chatbot, if they don't already. There's no opt-out, though the company calls it just one more signal in the mix. The move shows how Zuckerberg's AI push is being folded back into Meta's ad machine, which drives nearly all of its revenue. And Peloton is cranking out pricier products to try and revive its ride. The new bikes, treadmills, and rowing machines will have swivel screens, faster chips, built-in fans, and voice control. The company is also rolling out a new AI system for personalized coaching guidance. Peloton CEO Peter Stern joins Bloomberg Television today at 12:30 New York time to talk about that new offering and how it could help the bottom line and the stock. Speaking of those two things, front and center with Nike, the shares are climbing this morning. Results came in slightly ahead of expectations, though the company warned its recovery will be anything but smooth. Let's discuss the company's turnaround plans with Kim Basin. He is a senior reporter for Bloomberg News. Citi's Stuart Kaiser, my guest co-host for the hour, sitting with us here on set. Kim, talk to me first about the comeback. This is something that we talk about seemingly every quarter now for Nike. Is it really finally here?
Yeah, Nike had one of its worst years ever last year, and these are the first signs that the new CEO's comeback is starting to work, right? So he set the stage last quarter. He said that would be the bottom for Nike. Like, this is finally the inflection point. This is the time where Nike will begin its comeback. And right now, it looks like there's some hope here.
And from like a fundamental perspective, what are we seeing from Nike today that would give us confidence that that's actually happening?
Yeah, so sales weren't as bad as expected. They expected them to be down mid-single digits, but now it was down about 1%. But there's one crucial category for Nike that it lost a lot of hold of over the past 5 years or so with rivals like On and Hoka. It's the running category. And Elliott Hill, the CEO, said running is up 20% this quarter. And they've refreshed all three of their biggest running lines. And that's just such a crucial category for Nike and what it was built on once upon a time.
I'd note the stock's down over the last 5 years, like 41%. But the PE, the forward PE is more than NVIDIA. They're trading at like 43 times forward earnings. Is this a stock that the street likes? Because, I mean, for running, you got to figure this is the OG, right?
Yeah, it feels like a stock that the street wants to like, right?
Yeah.
And it's Nike's one of these old school American brands that everyone's kind of rooting for. And you can see it in their marketing right now, too. They've been spending more marketing this year, spending more on marketing this year. You saw them have a Super Bowl ad. One of the big things with this new CEO is refocusing on sport. He felt that Nike had gone too far away from their sports ethos into lifestyle sneakers and all this fashion stuff. So running is part of that. So is basketball. So is global football, training. All these things are what Nike wants to focus on.
Can I just ask about, we think about Super Bowl ads, and I, look down Fifth Avenue to see what shoes people are wearing. But it's not just about the United States, right? China has to be a huge market for a brand like Nike. How are they doing there?
It is a huge market for a brand like Nike, and China is lagging far behind North America right now. Nike has hit several speed bumps there over the last 5 years, and the recovery there will take longer, and their executives have admitted it will take longer in China to fix things. They have thousands of like monobrand stores, which means like Nike stores with the swoosh on it, and stores that it works with, franchises. It's just going to be a tougher effort for them out in China than it will be in Europe and the U.S. and other markets.
Stuart, the consumer always front and center here. Obviously, that's that kind of spending is 70% of our economy. How does the consumer look to you in terms of, ability to spend, what is it, $100 or $150 on a pair of trainers?
I think if you took out the labor market, the consumer looks pretty good, right? Retail sales actually came in stronger than expected. If you're thinking about Nike, you got a couple Olympic years ahead of us, which I'm sure they're going to lean into hard. The ADP report, obviously today, a little troubling, and the negative momentum in jobs market kind of concerns you a bit. So our view is U.S. consumer has kind of been the white knight of the U.S. economy now for a long period of time, and that's why the employment market is so important to us, because spending has been robust, but you are seeing some kind of cracks under the surface on the labor market, which kind of makes you worry about the forward a little bit.
By the way, Kim, how about the effect of tariffs on Nike? I mean, has the CEO, Elliott Hill, tried to get closer to Donald Trump, tell him how good he looks, tell him how great he is, Might
as well give it a shot, right?
Yeah.
Nike expected $1 billion in tariff impact and extra costs. They've just said it's 1.5 now as tariff costs increase.
So worse than expected.
So even worse than expected, and that just came in this last earnings report.
So that adds to the kind of volatility, the bumps in the road that we're expecting. Kim Basin, thanks so much for joining us. Stuart Kaiser is going to stay with us as we get these markets open. Just about 8 minutes to go. Coming up in the next hour, we're going to talk to an analyst about Nike. Cristina Fernandez covers the brand from the Tesley Group. She's going to talk about her view on the firm's turnaround plan and new product lines like Skims. Oh, we didn't get to Skims. We'll get there eventually. Ford, The motor company just released third quarter sales. Overall sales rose 8%, and EV sales jumped 30% as the tax credit expires. Consumers rushing in to get those deals. We'll talk about the auto sector as well. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are shut down, and as a result, we're looking at red arrows across the board. S&P futures down 0.5%, NASDAQ futures and Russell futures as well. Still ringing the opening bell at the New York Stock Exchange. You've got Neptune. It says NP listed. NYSE. I don't think NP is the ticker, but if you think I'm wrong, shoot me an email, mtmiller@bloomberg.net. Down on the NASDAQ, Hologic is ringing the opening bell. Their stock over the last 5 years is unchanged. I mean, it's only up 1 or 2%, but if they're doing more to fight breast cancer, it's worth it. And this is the start of Breast Cancer Awareness Month. For all of October, you'll see a lot more pink ribbons out there. In terms of your stocks to watch today, Nike is one of the big ones. We just talked about this with Kim Basin. The shares are up more than 5% in the cash trade as the company shows a comeback is underway, although they say it's going to be a bumpy ride and tariffs are going to cost $1.5 billion. That's 50% more than they had previously estimated. Lithium America is right now up 26%. You've already seen a huge run up in this stock as there were reports the U.S. would take a stake. Now that has been confirmed, and the stock, although it's very small, up on that confirmation. And then Meta Platforms right now down 2%. Not sure if it's connected, but Meta says it's going to use your interactions with its chatbots. For example, it's going to listen to your conversations with Llama and then give you targeted ads on Instagram and Facebook. If you want that, it doesn't really matter because you can't opt out. Let me get back to the desk right now. I'm going to bring in Citi head of U.S. equity trading, Stuart Kaiser. And just to talk quickly about the shutdown, Stuart, again, we're only 9.5 hours in, and it does look like the markets are down. I'm not sure if that's a reflection of the shutdown or of the gains that we saw in September. How much does it matter?
I mean, it matters. I think this morning, a little bit of the shutdown, the ADP number was weak. And, again, ADP probably, to Mike McKee's point earlier, not tier one employment data, but it's the only thing we have. So the market has to trade it a little bit. And, yeah, look, we had one of the strongest Septembers we've seen in a number of years. Markets are pretty high. You're adding in kind of some uncertainty around the government. So I think all of those things kind of conspiring to give you a modest down day. But, again, we don't think the shutdown, unless it is really extended, is going to be that meaningful for equity markets.
It's a great time, I think, to reflect on what has been a pretty amazing run for stocks. I mean, the S&P is up 13%, and not after a couple of bad years, after some bangers, right? Especially considering the fact that we have these massive tariffs compared to where we were before. And economists all over the street were telling us that was going to gum up the economy. It doesn't look like that's happened so far.
It doesn't seem like it. I mean, definitely there's some risk on the labor side, but the rest of the economy seems to be functioning pretty well. I think, coming in, people were thinking, well, in the previous Trump administration, he did the good stuff first and the bad stuff second, like if you did the ordering. This time, the theory was, well, he's doing all the tariffs and stuff ahead of time. That's going to create a negative impulse, and then we'll get the positive news after. The fact is the tariffs have not really disrupted the economy yet.
Or the mass deportations.
And then you also have, frankly, you're getting positive momentum on the regulatory and tax side that are going to help you. So, yeah, I agree. Surprisingly, obviously positive year so far for the S&P 500, very driven by the AI theme. I mean, we took our AI CapEx spending numbers up 25% yesterday. The previous estimate was only made a month ago. So that gives you a sense of, A, how powerful that theme has been, and also how rapidly it's accelerating. So it's really hard to ignore that as a chief driver.
I mean, I saw some data a couple of days ago about foreign investors increasing their U.S. equity holdings, and I thought, wow, they're not shunning us. In fact, they're putting more money into U.S. stocks, and I guess that is all because of the AI play, right?
Yeah, you cannot own the AI theme without being in U.S. equities. And look, at the beginning of the year, there was a lot of money, seemed like it was destined for Europe. And frankly, I think the biggest problem with that trade was that the U.S. equity market sold off 20 or 25%. And I think some of that money that was on its way to Europe kind of U-turned over the Atlantic and came back into the U.S. because, wait, I can buy the U.S. market now at a 20% discount and have full exposure to that AI theme. So, yeah, it's without a doubt what's the key driver of the market. AI power generation as well, one of our favorite themes, and we're still very positive on that.
The power gen is crazy. We had an amazing story the other day on how much it's driven up electricity prices, but that just shows the huge demand.
I agree. And if you look at the gubernatorial race in New Jersey, this has become a key topic. Kathy Hochul in the U.S., in New York, working with Trump to get natural gas. You look at out in California, they're now negotiating with these oil prices. I mean, when those big blue states start really focusing on energy costs, A, it's going to be a huge political issue, but B, you also know it's a serious challenge kind of facing.
If I look at commodities, I mean, GLCO is the way to pull up the big page on the Bloomberg terminal. Gold at another record high right now, 38.74, and obviously with the dollar weakening, that makes a little bit more sense. But do you, as an equities strategist, do you advise your clients also to hold a little bit of this, or even the producers of gold?
Well, it's funny you mentioned the producers of gold. I think that GDX is up almost 100% year to date. So you've gotten gold prices to a level where the operating leverage in the gold miners is now playing into it. To your point on the dollar, I think earlier in the year, people wanted to be short the dollar because of tariffs. There weren't any other currencies that necessarily wanted to be long, so they ended up in gold. The only thing that worries me a little bit about gold right now is no matter what scenario I put out there to someone who's bullish gold, they tell me gold is going up in that scenario. So it does seem like sentiment is really there. But
kind of like crypto people, right?
Exactly. There's no bad news.
You're right about the GDX. It's actually up 128% year to date. So it's done incredibly well. Outside of, this ETF or outside of the AI and even the energy play, is there anything else that you like? I mean, do you have faith in the S&P 493 to be able to boost earnings as much as the Mag 7?
I mean, we really hope so, because if you look at how the market has been performing lately, it's S&P 500 up quite a bit, Russell 2000 catching up, but the S&P 493 or S&P equal weight has actually lagged both of them. So it's very interesting. The belly of the market has kind of been really underperforming. And yeah, to your point, what you need there is a broadening out of EPS growth. We've seen little hints of that, here and there. But look, at this quarter and next quarter, we're really going to need to see that happening for that to work. Otherwise, look, at Mag 7 equally weighted, it was up almost 800 basis points, 8% last month. So we would love that trade to work, because I think that means earnings is broadening and the economy is very solid. It just hasn't happened, and I think it's a show-me story right now.
Stuart, great having you with us. Really appreciate the time you spent with us today. Stuart Kaiser is the head U.S. equity strategist over at Citi. Let's get a check right now on how the market is doing. Just a few minutes into the open, we're looking at losses, but only about 0.25% on the S&P. This is the move screen, which I think is the most dynamic way to look at the S&P 500. We got it arranged by points, so you're going to see on either end of the barbell really the biggest companies in the market. Apple is the biggest gainer right now, adding 7 points, and you've got then Eli Lilly, Visa, and Thermo Fisher Scientific. You're going to see some of these, Merck, for example, and Lilly, AbbVie, some of these companies coming up with Pfizer after the announcement that they made yesterday in the talk with President Trump. NVIDIA is the biggest loser in terms of point reductions, taking 4 points off of the index. You see Facebook there as well, Meta Platforms with Microsoft, JP Morgan, Broadcom, and Google holding the market down as well. In terms of the sectors that are moving right now, and it's still obviously very early in the session, but you see healthcare the biggest gainer. And that's what I'm talking about with Pfizer, with Lilly, with Merck. All of these drug makers doing better, rallying on the news that we got yesterday in the press conference with the president. Utilities are also doing well, real estate and consumer discretionary. These are really defensive. Actually, all four of them really are defensive sectors. So when these lead, that's not really bullish. And you do see the market obviously weighed down by communication services. These are the big hyperscalers, financials, the big banks, industrials, and consumer staples. Now, coming up, the Fed lowering the stress capital requirements on Morgan Stanley. We're going to take a look at their decision, plus more on the government shutdown next. This is Bloomberg Open Interest. Quick check on stocks. Just about 12 minutes into the session, we are looking at losses that aren't quite as severe as futures had indicated. Right now, the S&P 500 trading at 66.77 is down less than 0.2%. And September was a fantastic month. We were up more than 3% on the S&P 500 in a month that, at least over the last 30 years, has been one of the worst of the year. Let's get to our top calls right now. Some of the analysts' action and focus this morning. First up, AT&T is getting downgraded over at Barclays. The analyst says tailwinds are beginning to moderate and sees limited upside for the share price. Telephone is up nearly 25% so far this year. It's done well, and maybe it's time to take profits. Next up, Carvana is getting upgraded to a buy at Jefferies. The analyst sees the online car retailer delivering elevated growth. He says it's best positioned to benefit from a nascent shift to digital in the $800 billion used car market, and I can't imagine buying a car any other way at this point. Finally, chipmaker Marvell Technology is getting cut at TD Cowen. The analyst cites limited visibility and cautions that its custom chip business could stagnate or decline next year as the competition heats up. Marvell Technologies down in the cash trade more than 2%. Let's turn back, though, to this morning's top story, and that is, of course, the shutdown. Bloomberg Intelligence senior policy analyst Nathan Dean writing in a note ahead of this event that, quote, the most likely scenario is a short-term stoppage with reopening feasible as soon as the October 4th weekend. We look for policy implications of the shutdown. And for that, we go to Nathan Dean. He joins us now, America's dad, without the vest. Nathan, what are the implications in terms of, for example, an effect on the economy? I think the 2018-2019 shutdown erased $11 billion, but we got 8 of that back. So at the end, we only lost about $3 billion of GDP.
Yeah, so I think there's really 3 impacts that we've been telling our clients. And the first is, when it comes to the markets in particular, the 2018-2019 shutdown showed a dramatic drop in the S&P 500. And based off of today's data, we haven't really been seeing that. So a lot of it could be headline risk. And I think folks are more accustomed to a partisan Washington than they were before. The second is data. Obviously the Bureau of Labor Statistics is not working, and there's a lot of data out there that our clients are using, whether it's jobs data, commodity data, et cetera, and the data is not going to be there. And then finally, the economic question, like you mentioned, 750,000 government workers are furloughed right now, and they're not going to get paid. The next major paycheck comes in next Friday. So if you're trying to game this out, obviously the next 2 to 3 weeks are going to be important. If this shutdown goes further, that's when you're going to start to see the economic impact of that, primarily here in the Washington, D.C. region to start, but then I think it just trickles throughout the rest of the United States.
I just want to point out a function on the Bloomberg a lot of people have mentioned today, Nathan. WSL space ALTE shows alternative data sources that you can use while the government is, while the federal workers are on furlough here. How many firings do you expect, and how many are going to come back? Because the Trump administration, one of its main goals has been to shrink the size of the federal employee base. This is an opportunity for them to do it. President Trump says it's likely, and he can blame the Democrats for it. Is he really going to go through with it?
So right now, I think we're at the point where it's still political posturing, and I don't think there's actually a plan yet. I mean, I take that back. The Office of Management and Budget and Director Russ Vought certainly has a plan, but it's not up to him. It's up to President Trump. And I think what happens here is you're going to see negotiations take place later this weekend, and then that's when the decision will be made. Should we move forward with this or not? Because, look, if the president decides that he wants to just lay off a lot of these workers, there are court cases that are mostly going to come, but they can move forward with this progress. But I would point out is that the Virginia, Maryland senators in particular can stave a lot of this off so that if the threats do come forth, then you could have those 2 Virginians and 2 Marylanders come forth and say, look, I'm going to support to reopen the government, because if they do that, then you stave off and you can get ahead of the OMB.
Can you clear up something that I've heard the president say and a number of Republicans, that the Democrats want to give illegal aliens free health care? Is that really the case? I know the Republicans wanted to pass a clean CR, and the Democrats want to add about $1.5 trillion in health care and other funding. But is part of that somehow going to allow undocumented immigrants access to free health care?
You know, this is one of those talking points where both sides are right and both sides are wrong, and they're really just pointing at the portions that they think play politically advantageous to them. And that's where the problem is with the shutdown at the moment, is because both sides go into a shutdown thinking that they are the ones that have the best political positions. The Republicans offered this clean CR through November 20th. You know, they think that they have the moral high ground. The Democrats, on the other hand, say, look, we want to be seen fighting President Trump, and we also want to fight for these Obamacare subsidies that expire at the end of the year. And I don't think they're going to get that while the government is shut down. But this is where I think this solution potentially could be found, is that if the Democrats later this week or beginning more likely next week come to figure it out that they can actually achieve their goal of fighting President Trump with maybe a gentleman's agreement or an unofficial handshake that they will deal with the Obamacare subsidies later, because I think that's something that President Trump wants. The rest of his party may not, but I think President Trump certainly wants to take care of these Obamacare subsidies before the November 2026 midterms. That's where the solution will be found, and ultimately I think the government stoppage can end.
Nathan, we have obviously a large portion of our viewers are working at banks, probably many of them at Morgan Stanley, and now they have diminished regulation to deal with. This is one of the promises of the Trump presidency, right? We have the Federal Reserve, not that they're working in lockstep with the administration, lowering the capital requirement, the buffer requirement to 4.3% from an initial 5.1%. Are we going to see continued moves like this?
I think so, because this is an easy win for the Federal Reserve. This doesn't have to go through a rulemaking. What happened here is that Morgan Stanley petitioned the Federal Reserve as part of their stress testing process to lower their what's known as stress capital buffer from 5.3% to just north of 4%. And the Fed looked at it and said, you know what, you're right. Now, it doesn't have to go through a rulemaking, and so it's an immediate change. This takes effective today. And so now Morgan Stanley is a little bit better situation because, in their view, they've been overpaying for this. Now, that the deregulation argument when it comes to banks in particular is still a story about time. This was a quick win for the Fed, and this only applies to Morgan Stanley. But when you're talking about other things like the Basel III endgame or any type of GSIB surcharge change that is applied to Bank of America or JP Morgan or Citigroup, that still remains in the idea that proposals have to come out, proposals have to be worked on, and it really isn't going to hit your bottom line until 2027. So if you see more stress capital buffer petitions coming from the industry, think short term if the Fed is okay with it, everything else long term.
All right, this is why you're so popular at Bloomberg Intelligence, because people know you have the answers. Nathan, thanks so much for joining us. Nathan Dean there of Bloomberg Intelligence covers the government policy and all the regulations coming out of it for us out of Washington, D.C. Coming up, electric car sales broke records last quarter, even amidst the supposed backlash. That's because the tax credit is expiring or has expired, and you'll no longer be able to get $7,500 back. We'll talk all about how it's affected Ford and General Motors next. This is Bloomberg Open Interest. Car makers saw a surge in new electric vehicle sales this past quarter. Sales of purely battery electric vehicles rose 21% from the prior year as the EV tax credit was set to expire and now has. Bloomberg's Gabriella Coppola reported on this. She joins us now from Detroit. So, Gabby, I guess it's just this incentive alone that's driven people, consumers, out to dealership lots or online to buy new cars.
I think, that was a driving force in this quarter. There's obviously, I would caution that EVs are still, they're supposed to hit a record penetration level this quarter, 10% of overall new car sales, and that's a record, just 10%. So people are still buying cars for other reasons too. And I think a lot of it is, you look at this year, and there's been all these kind of weird distorting factors in auto sales. This spring, we saw a huge boom because of people worrying about tariffs and the cost of cars was going to up. So that and the car makers totally exploited that, and they said, come get your car now. It's pre-tariff. You get a great deal. So we saw a lot of that in April, May, and March. And then now we're getting another sort of policy-driven bump. And people, including myself, going out there and saying, man, if I want to get a discount on this EV, now's the best time to do it.
So the thing is, I had seen eye-poppingly low numbers for EV sales from the Ford Motor Company. How have they done? And how much of this is going to GM has, a lot of product offering. Tesla, obviously, only in this space. And also, what did you buy?
Oh, okay. So I got a Kia EV6. It was a tough call between the Mustang Mach-E and the Kia EV6, but they're both really sexy cars, and the Kia gave me the better deal. So there you go. But I'll probably get crap for that. But anyway, so on top of that, I would say that there's other, like GM has definitely benefited from this. The Chevy Equinox. I've seen those all over Detroit all of a sudden. I'm seeing Mach-E's, Chevy Equinox EV. Kias, I'm seeing a lot more, Hyundai Ioniq 5, I'm seeing a lot more of these vehicles around. So you could see that people are taking advantage of these deals. Tesla also, I think, they're predicted to have done quite well this quarter, sales of the Y and the 3. I mean, there's a real pull for people to feel like this is a great deal that's going away. I will say that even though we were all led to believe that September 30th was the last day, it does look like some automakers are going to extend this on their own dime for a little bit, or there may be some sort of financing behind it that I don't understand all the details, but I think, you're still, for cars that are in transit or already on a dealer lot that are an EV, if you're leasing it, I think you could still get the deal. That's what GM has told us. Hyundai came out and said they're going to extend this deal in October for the Ioniq 5, and they're also lowering the price for the 2026 model. So the market has to, you can't just take this subsidy out of the market like abruptly, and that's going to create friction in the market. So the automakers are trying to do things to kind of ease it out, But I think going forward, we'll see a lot more hybrids. I mean, that's what Hyundai is talking about. They're selling their hybrids, yeah.
Yeah, and Jim Farley is pumped on the E-Revs. Ram is about to come out with their E-Rev truck. So, All right, Gabby, we're going to keep on top of this. Bloomberg's Gabriella Coppola reports on cars for us out of Detroit. I want to point out that happening right now is Bloomberg's Women, Money, and Power event in London. My co-host Danny Berger is there moderating a panel on global real estate with executives from PIMCO, Blackstone, and AXA. Check it out if you like on the Bloomberg terminal. Type LIVE GO. This is Bloomberg.
Just that notion of income, and from that perspective, where you're coming in, because we think.
We are 30 minutes into the trading day, the first day of October, the first day of a shutdown in almost 7 years. Welcome to Bloomberg Open Interest. I'm Matt Miller. Danny Berger is on assignment in London. We're going to bring you some of her amazing interviews throughout the hour. But we begin with breaking economic data. ISM manufacturing crossing the wire right now. If I type up EcoGo on the terminal, I can see that the numbers are out with slight beat and a slightly better number than we had in the previous reading. Fortunately, I've got Michael McKee, Bloomberg's international economics and policy correspondent, here with me on set to tell us what this all means. Mike?
What it means is a little change in the outlook, at least for the manufacturing sector. 49.1 from 48.7, not a big change, and it is still in contraction level. Prices paid 61.9 from 63.7 continues to go down. That is some good news, except it's still at a very elevated level. And then employment, 45.3 from 43.8. That is a better than expected number. But again, we're looking at numbers that are all in the 40s here, and that signifies contraction. Anything below 50 roughly does, and that is not good news. The ADP number this morning is at 2,000 manufacturing jobs lost. So that is certainly a possibility for the non-farm payrolls number we probably aren't going to get on Friday, Matt.
I just want to point out, prices paid is not below 40. That's above 60.
Yeah,
which isn't
working
great,
the
right?
other direction, yeah.
Because that's a number that we want to be lower, I would imagine. It is a little bit lower than the estimate.
Well, we have to look at what the comments are and what people are saying about individual categories of costs for them. But it does look like we're still seeing some tariff impacts in the pricing of goods.
Not everybody has forgotten about the inflation side of the mandate, right? Beth Hammack was talking about that yesterday. Mike McKee, thanks very much. Michael is our international policy and economics correspondent. I want to point out House Speaker Mike Johnson and Senate Majority Leader John Thune are set to speak in Washington this hour. Let's get the latest update on the government shutdown with Bloomberg Washington correspondent Tyler Kendall. She joins us now. So what are they going to say? I mean, they killed the vote yesterday, right?
Right, exactly. Though, Matt, we are expecting another vote to happen today on the same exact bill that Republicans are pushing forward with. They're proposing what's known as a clean CR, a continuing resolution that would fund the government through mid-November with no other provisions attached. The issue at hand, though, is that Democrats want to see some policy changes made now and attached to this government funding bill. There's a range of things that they want to see, but it really does all come down to health care. There are certain health care provisions that they want to see rolled back that were enacted under the One Big Beautiful Bill, like those Medicaid work requirements, as well as they want to make permanent those expiring Obamacare premium tax credits that are ending at the end of the year. Now, Senate Majority Leader John Thune has previously signaled that perhaps there could be a negotiation on Democrats' chief ask, which is extending those ACA tax credits. But Republicans are holding firm that any sort of discussion related to that is going to happen until after the government is funding. They do have until the end of the year to reach a deal on those negotiations. So, Matt, we're going to have to wait and see, because at this point, both sides seem really dug in. As you well know, Republicans ultimately need 7 Democrats to get on board. It's really 8, because we are expecting Senator Rand Paul, a Republican from Kentucky, not to vote with Republicans on this bill. So far, we've seen 3 Democrats cross over according to the vote last night, but that still means that Republicans need 5 more votes to go along with this.
Why, Tyler, just quickly fill us in. Why is Rand Paul not voting with the Republicans, and how many other defectors could we see from the Democratic side?
So this was widely expected from Senator Paul. He has often said that he's not going to vote for government spending bills that keep the levels from where they've previously been allocated. He wants to see more fiscal austerity in these bills going forward. When it comes to the Democrats that we're closely watching, we're watching those lawmakers that represent areas close to the Washington, D.C. metro area, in Virginia and Maryland, amid the threat of permanent layoffs to federal workers. But I'd also keep my eye on 2 of the retiring Democratic senators, Gary Peters of Michigan, as well as Jeanne Shaheen of New Hampshire. They both have signaled a willingness, perhaps, Matt, to fund the government so that they can have these negotiations on the expiring ACA tax credits down the road.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there in Washington. By the way, you can see House Speaker Mike Johnson and Senate Majority Leader John Thune. They are speaking in Washington right now, and we will bring you any headlines that come from that press conference. You can also type LIVE GO on your Bloomberg terminal to follow along yourself. Let's continue the conversation, though, on the shutdown and how it's affecting markets with Ann Berry, Threadneedle Ventures founder. And you've seen a couple of these. As I said, the last one was 7 years ago, and then 2013, we had a big shutdown as well. How much do they affect equity markets, in your view?
In the short term, not very much, Matt. And I think we're at that moment where we're trying to figure out how long is this really going to last. If it's going to be short-lived, I don't think this is going to impact the tear that we've seen the markets on. If it looks like it's going to turn into the 34 days that we last saw 7 years ago, that's a different matter. And I think as we nudge towards that kind of runway, perhaps we'll start to see a bit of a break in the market.
One of the things I was thinking about when looking through your notes in the editorial meeting this morning is the companies that will be affected or could be affected because they get so much government spending. Palantir, for example, is a stock we talk about a lot. Are there any companies that you're focused on that may take a hit from this, or maybe that won't take a hit because they're going to get the money no matter what?
So I think Palantir's in that last bucket. I'm going to come back to that. The ones that get a hit, I do think there are people like Leidos, for example. I think Booz Allen, right, the consulting firm. These were coming under the spotlight anyway. I think this kind of government shutdown just shines the light even further. I think this is bad news for those kinds of names. Palantir, you think about the flip side of this. Palantir's argument could at this point be, well, when you get shutdowns, when you get people or, quote, non-essential workers not being engaged in the same way, this is where software can jump in. So I actually think the Palantirs of the world stand to gain from these kinds of outcomes.
So we can substitute now AI or some kind of software for humans working in the federal government. Do you think we're going to see a real reduction in those federal employees, or is that just political bluster?
I think we can see it. I think we've already seen some of that. And
That's true. Actually, today, I think you've got those deferred resignations from the Doge.
From Doge, exactly.
Now 150,000 federal employees are going to be out today.
Well, some are going to be called back. We think the hiring, there was some complexity around figuring out who was being let go, and I think the government is trying to sort of regain some of those talents. But this idea that software or technology is going to replace federal workers is something that's been in the Trump administration's narrative now from the very get-go. None of this is a surprise. And I think, as with business, I think government will do taking, it's that expression, never waste a good crisis. I think these are the moments when the government, as business would do, by the way, and say, look, this is the kind of extraneous challenge that's going to force the adoption of software and replace people. I think it's coming.
By the way, the shutdown aside, Anne, what's your view on the market right now? What companies or sectors do you like? Is it still the big AI players, or is there anything that stands out to you?
Well, the big AI players, Matt, I've talked about this. I've been worried that this has been in a very expensive market for a while. I've been taking some money off the table. It's been bubblicious. And I don't think that's changed. And you saw it even the run up to the shutdown, right? We still saw a fantastic September. You said that at the top of your show. There are certain sectors I'm starting to look at again and say, look, is this where we do a bit of a return to some actual products as opposed to software? Places like beauty, you and I have talked about, we're seeing that category, I've spent a lot of time in it, drive traffic into retailers. And so we're seeing people like the Gap get back into that sector. So it's a little bit more going back to the hard stuff and the product.
And I got to say goodbye to you, unfortunately, now, because we are going to go to that presser in Washington. But thank you so much for joining us. Anne Barry of Threadneedle Ventures. We could talk to her for the hour. But instead, we're going to listen to House Speaker Mike Johnson and Senate Majority Leader John Thune on the shutdown. They're speaking in Washington. Let's listen in.
And we encourage our Democrat colleagues to do that. I certainly pray they'll come to their senses soon, do the right and responsible thing. The reason they will have one more opportunity today is because of the sound leadership that is being provided in the U.S. Senate by our colleagues who are standing here with us. This is a joint press conference, as you know, between the leadership, Republican leadership in the House and the Senate. And I'm delighted to yield to my good friend and an extraordinary leader in the Senate, Leader John Thune.
All right. Well, thank you, Mr. Speaker, and our House colleagues for doing the work. You sent us a clean, continuing resolution. Unfortunately, we are here this morning in a government shutdown that the Democrats wanted. Chuck Schumer, at the behest of a bunch of liberal, far-left activist groups, has walked his Democrat colleagues into a boxed canyon. There's no way out, folks. There's no way out. This could have been avoided. It's totally unavoidable. And everybody's now asking the question, how does this end? Well, it ends when the Senate Democrats pick this bill up, passed by the House of Representatives, and vote for it. It's on the floor of the Senate. We're going to vote later this morning on this, 24 pages. Does this look partisan? Does this look dirty to you? 24 pages to fund the government. Nothing more, nothing less, nothing else. The House kept it simple. We kept it simple in the Senate. This is something, as the Speaker noted, that 13 times in the past Senate Democrats have done when they were in the majority and Joe Biden was in the White House. This is a very straightforward issue. It's not complicated. They want it to end. Vote with us to open up the government by voting this out of the Senate today, putting it on President Trump's desk, and he will sign it into law. President, House Republicans, Senate Republicans, we're all united on this. And what's interesting now is some of the Democrats are joining us. Our vote last night was a bipartisan vote. There were 3 Democrats that came over and voted with us because they know this strategy is a losing one, and it hurts the American people. It's not about who wins or who loses or who gets blamed in all this. It's about the American people. And they have taken the American people hostage in a way that they think benefits them politically, but at the consequence and the cost of what's going to happen to the American families if this government shutdown continues. And so I'm glad to be here with our Republican colleagues. Our Democrat colleagues in the House have been around here the last few days, I guess, flailing around, celebrating the fact that they voted to shut down the government. How ironic. Well, this can all end today, folks. It needs to end today. We will continue to work together with our House counterparts, with the President of the United States, to get this government open again on behalf of the American people. Next up is, there he is, the leader.
Thank you, Leader Thune. Today marks day one of the Schumer shutdown. As Speaker Johnson pointed out, this didn't need to happen. House Republicans came together weeks ago to prevent a government shutdown. We brought as straightforward of a bill as you can have to say, let's allow government to be funded for another 2 months while we negotiate our differences. Clearly, we have differences with Democrats right now. One of the Democrat leaders confirmed yesterday that Democrats shut the government down to fund health care for illegal aliens. That is no way to hold the American people hostage over some far-left demand. You know, we had an election in November where the country came together and said, let's send to Washington leaders who want to solve problems and get our country back on track. And we've been working feverishly to do that, to get this country back on track, to get the economy moving, to lower inflation, to lower interest rates. And Democrats, just to appease their far-left radical base, have been voting no every step of the way. Well, today it has consequences.
You just heard from House Speaker Mike Johnson as well as Senate Majority Leader John Thune. They're speaking in Washington with some of their colleagues. You can type LIVE GO on your Bloomberg terminal if you'd like to continue to follow along. We'll bring you any headlines as they cross. Coming up, Sailpoint CEO Mark McClain joins us to discuss the AI security arms race. Cybersecurity, more important than ever. This is Bloomberg. Let's get now to high interest. Look at what's making headlines around the world. Peloton shares are falling the most since June after the fitness company introduced pricier products today. New bikes, treadmills, and rowing machines will have swivel screens, faster chips, voice control. Along with the new models, Peloton is announcing a significant price increase and subscription prices as well. The CEO, Peter Stern, joins Bloomberg TV today at 12:30 New York time. Oura is dressing up its latest health tracker with a jewelry twist. The $499 Oura Ring 4 ceramic. The new ring is a nod to the brand's majority female fan base. Alongside it, Oura unveiled a charging case, a blood test integration with Quest Diagnostics, and a recycling program. The launch comes as the company lines up an $875 million raise, giving it an $11 billion valuation. And McLaren boss Zach Brown cashed in big, pocketing over $50 million after ending the team's 26-year title drought and winning the Formula One title last weekend. The win lifted McLaren's revenue 23%, with profits more than tripling. It comes after McLaren was valued at over $4 billion in a stake sale last month, highlighting investor bullishness about the sport. Turning to cybersecurity, as a growing number of companies adopt the use of generative AI tools and autonomous agents, they continue to face new security challenges. Joining us now to discuss is Sailpoint CEO Mark McClain from Austin, Texas, where the company's annual global conference is currently underway. Mark, this is, I think, an especially interesting time to be in cybersecurity as we prepare for AI to really take on agency for humans. How big of a step do you think that is? When my chat bot gets my credit card number and can go out there and buy plane tickets for me, how important is it to have real security?
Well, it's a great question. Excuse me, I think in terms of what's happening, while those chatbots are going to do interesting things for the consumers, I think the era of a lot of concern in the average corporate enterprise today is what those incredibly powerful tools, which can add great competitive advantage, also present tremendous risk. It's very interesting. You guys just had a segment on F1. We often use that as a metaphor in the realm of security. And the idea there is this, why do incredibly fast cars have great brakes? The answer is so they can navigate through challenging times and get back to speed again. There's a tremendous pressure in the realm of artificial intelligence in the business community to adopt these technologies, to create new opportunities, to try to strive for new competitive advantage. But there's a pretty well recognized risk of the power of these agents have, and if they're not managed and governed and secured, what kind of information could they access, and how might that be turned to abuse by the bad actors?
So I wonder how much AI itself is a threat compared to humans. Right now, right, all of the hacking or most of the hacking that you track and defend against is initiated by humans. Do you expect AI eventually itself to initiate cyber attacks?
Absolutely. And of course, that AI will be directed by humans in many cases, right? But why is it more of a threat? Right? The AI directing itself is obviously part of what we're all worried about, but that's in the realm of Will Smith movies that I can't comment on. But I think at the end of the day here, what we're really seeing is the power of these tools to access information at, we would say in technology, machine speeds, right? A human can only do so many things in a limited amount of time. A piece of technology can maybe do 1,000 or 100,000 times as fast, that kind of bad action. So if these tools are used to kind of try to compromise and get into these systems to where the data resides that protects these key enterprises, that's the concern that the security professionals have today. They're looking to companies like Sailpoint to say, how can you help me both take advantage of this technology for my business needs while protecting my business and ensuring that my data is safe? That's the big tension that people are feeling today.
By the way, Mark, in the identity space, right? You're securing the identity of humans, but I imagine you'll soon be securing the identity of autonomous AI agents. How long do you think it'll be until that's a significant number? And at some point, do you expect that to overcome or pass human identities that you defend against?
I'll tell you, it is everybody's interesting guess is how fast that will surpass it. There's almost no debate that it will surpass it. If you just used really round numbers, there's 8 billion people in the world and maybe 5 billion of them work at any point in time. And some subset of that is what we're securing for a lot of the world's corporations and its enterprises. On the other side of that, though, is estimates that range from a handful, 2 or 3 to 1, to as much as tens or hundreds to 1 of agents that will be operating on behalf of these employees and these organizations. And so this need to manage these autonomous AI agents as another identity is rapidly approaching, and we're seeing interest in that now. We launched a product this week at our conference called Agent Identity Security just for that issue. So where our customers are demanding that, they see the need, and they're looking for companies like Sailpoint to help them ensure that they can protect their data while they take advantage of this powerful new technology.
We have, Jeffries showed yesterday, a resurgence in M&A, and certainly in your industry, it's active. What's your stance on remaining independent? Do you want to maintain, focus on, these issues, or would you make acquisitions to build out your brand and your offering?
Companies take different approaches. It's a great question on how to approach these things. We tend to look at most of the M&A type of work we've done to bring in what we would call technology accelerates, meaning we have a roadmap, we have a vision for where we want to go with our customers, and we sometimes find younger, earlier stage technology companies that have already advanced that dimension a bit. And so if we can accelerate through an acquisition, the classic build versus buy technology choice that a lot of us make, that's what we'll do. We're not really in the business of accumulating more revenue through buying companies who maybe strategically aren't a great fit. We want to buy smaller tech companies typically that are going to accelerate where we want to get to in the realm of AI, in the realm of managing machine identities, AI identities, and importantly, the tie-in of the identity world to the security landscape, like all these security tools we're familiar with, Palo Alto Networks, CrowdStrike, great companies. They're often aware of vulnerabilities and threats in the environment. They don't have the identity context. The bringing together of Sailpoint's rich identity context, human and non-human identities, with that security context is what enterprises need today to truly secure their enterprise.
Does the proposed acquisition of the Palo Alto Network CyberArk acquisition change the competitive dynamics in your industry?
We'll see. It's not clear yet. What we've said about that is, CyberArk was a good partner to us for many years. We kind of were in complementary parts of the industry. They had recently, before the Palo Alto acquisition, acquired a small company that had a bit of a foothold in this space, pretty small foothold. And so we saw maybe on the horizon some potential for more competitive, but a lot of cooperation still with CyberArk. What we did kind of applaud, if I can say it that way, about that move was that it validated this need that we see of the identity landscape and the security landscape coming together. That was sort of the comments that Nikesh made from Palo Alto about we need to bring these domains together. We agree with that concept. We have a different approach, which is we want to integrate with all of the key security domains and not necessarily tie it together in one acquisition environment. So that's our approach, is to stay independent, collaborate with all those security players from Cisco to CrowdStrike to Palo Alto itself and others as customers demand, so we can deliver that integrated identity and security value prop. I understand why they made that move. For now, we choose to take a more independent path.
You've had record software as a service sales and increased urgency around replacing legacy deployments. How long do you think this wave lasts?
Oh, I think we are, to use a baseball analogy, which I know is somewhat less helpful in all parts of the world, but most people get it. We're in the early innings, clearly in the early innings of this game. Identity as a discipline is still relatively new to people. We've been managing networks and devices and the cloud environments for quite some time now. Identity as a unifying concept for security is fairly new still, and that incredible tension that's being driven by the rise of machine identities and AI agents is just refocusing more attention on this landscape. And so we think that the customers are going to see increasingly they've got to get control of all of their identities, particularly the non-human identities, if they're truly going to secure the enterprise. So we see kind of a lot of great potential ahead for Sailpoint.
All right, Mark, I hope we can speak to you again. Mark McClain there talking to us about cybersecurity and his industry from Sailpoint. Let's get a check on what's going on with the markets. Almost an hour into the session, we're looking at only a slight loss on the S&P 500 after a more than 3% gain for September. We kick off October right now down 0.1% at 66.80. The NASDAQ down even less. Let's call it unchanged at 24,665. The interesting moves, I think, today are in treasuries and in gold. As the government shuts down, you see treasury yields falling across the curve and gold climbing to yet another record high right now, 38.7250 per troy ounce. Still ahead, Joe Brusuelas joins us of RSM on the impact of the government shutdown on the labor market and the economy. This is Bloomberg Open Interest.
Well, it has been a very dynamic year, let's say. But at the same time, we feel very good about the U.S. economy. Our base case is for a soft landing. We think that the Fed is making the right moves by starting with a 25 basis point cut. We're looking for another 50 basis points this year, 50 basis points first half of next year. Corporate earnings are incredibly strong.
The macro backdrop so far is set up what we almost call a Goldilocks scenario, which is the economy is showing some of the macro factors that would suggest easing is in store, which is good for credit and good for companies and good for cost of capital. But it's also not so weak that people are concerned about growth.
Couple of highlights from Bloomberg's Women, Money, and Power event in London, happening right now, convening the most influential voices from across the global finance industry to discuss the critical issues of the day. My co-host Danny Berger is there now with Nubank's co-founder and chief growth officer. Danny?
Matt, thank you so much. I'm so thrilled for this conversation. Joining me, as you say, is Nubank's co-founder, Cristina Junqueria. Cristina, thank you so much for joining. Great to see you.
Great to see you, too. Thanks for having me.
And you just came off of a really wonderful panel as well with our Caroline Gage, which, of course, the inescapable topic of your growth was discussed. You've just applied for a U.S. bank charter. So how do you conquer the American market?
It's going to be a long shot, but the way that we think about this is our thesis is really a global one. We believe that everywhere consumers are going to continue to seek convenience, a more transparent and efficient experiences, and also that our cost efficiency advantage is going to translate to multiple markets. That's what we've seen coming out of Brazil and into Mexico and into Colombia. When you're able to serve customers spending less than $1 a month, like that allows you to get to a much wider total addressable market. And that's a little bit of how we're thinking about our, in general, about our international expansion. The U.S. market itself is, of course, like a huge opportunity, one that is very attractive, but that's just the next step.
Obviously, you have really big brand power in Latin America. How do you repeat that, though, especially as you expand to new markets where there may be other players who already have some of the brand name recognition?
No, for sure. It's a tall order for sure. We know that the U.S. market is going to be one hard to crack, like from a marketing standpoint. We do expect that, at least initially, if you think about an adoption curve, like the early adopters are going to be consumers that know the brand, right? And we do know that there's like over 60 million Latin originated people in the U.S. and that the GDP of some states, if you think about Texas or Florida, they're larger than Brazil. When you look at it. So we do expect that our early customers are going to be coming from the geos that we already serve. They're going to have some affinity with the brand. They're going to be the people more inclined to give us a try, like an experiment with the services. And hopefully we're going to get a chance to impress them with the products that we're going to offer.
Right. Well, of course, it's not just looking at the U.S. and not just globally, but even in Latin America, you've been expanding a lot. For example, changes in Mexico, even your home market of Brazil. How do you balance that rapid growth while retaining profitability and credit discipline?
That's a great question. So the way that we thought about this always, it's not necessarily a trade-off. Like we've always grown with a very profitable model. We took many years to get to profitability just because we were growing very fast. And when you're growing fast, like it takes investments early on in a customer's life cycle. So when you have a lot more customers coming in than you already have like on your back book, that's when the balance on profitability isn't at break even. But soon enough, we should be getting to profitability on Mexico and Colombia as that balance shifts into more of the back book. That's what we saw happening in Brazil, but the model is essentially the same. When we look at customers on a unit basis, they're very profitable, and the model is going to continue to behave that way.
Would you expand, and I know you have been in some places, but not just geographies, but type of credit offering? How do you think about that, of the products that you're also giving to consumers?
So we've always been credit first, which is something very different than a lot of fintechs around the world, right? That makes things very hard in the beginning because, you got to kick off from scratch, right? Like all your credit underwriting, you don't have a lot of data, but over time that becomes a big advantage. And we see a lot of companies now struggling to make the leap on the other direction, right? Like they've started on the side of liabilities, right? Like they started with an account and taking deposits, but then they have a hard time underwriting credit. So we think that this advantage that we've been building, including the use of machine learning and now AI, like for credit underwriting, is going to quickly materialize as a very strong advantage across all markets. And you combine that with the advantage that we're also able to build on the liability side, where funding costs hasn't been really, or even funding availability hasn't been an issue or a restriction, a constraint for us to continue to grow the credit book. So it's a very powerful combination.
Well, I think people have looked at your business model and found it attractive because a lot of the legacy banks are also increasingly trying to move into this space. How do you think about competition with them?
Well, we of course are very respectful of competition. These are institutions that have been very profitable, that have been around for decades. But we think that ultimately customers they're going to vote with their feet and their money, right, and their wallet. So if somebody comes in and presents them with a better experience, with products that don't have any of the fees that they're paying, that offer instant transfers. We were just talking backstage about that, right? Like how even within the same institution, people are still paying fees to transfer money. Like that just blows our minds, So we really believe that if we focus on customers and address their pain points, starting with this Latin population coming into the U.S. that has even more acute pain points when they're locked out of credit in the U.S. because maybe they're thin file, they don't have credit history. I think a lot of those pain points are going to be shared by a wider audience eventually.
Yeah. Why does the U.S. have so many pain points? Like this is supposed to be the home of innovation, and yet it feels like we're really behind on these issues.
You tell me. I just relocated to the U.S. It's been so tough for me to get a credit card, to get a bank account, and even within the same institution, like I had this fun story with people telling me on the credit card arm of a financial institution they didn't have a proof of residency for me. And I'm like, you have my mortgage. What else do you need? And so we do see a lot of inefficiencies there that hopefully we're going to be able to tackle.
Well, Cristina, we're really excited to follow along in your eventual world disruption. Thank you so much for joining. And Matt, of course, that is the Nubank co-founder and chief growth officer, Cristina Junqueria.
All right, Danny, thanks very much. Danny Berger there with Cristina Junqueria at Bloomberg's Women, Money, and Power event in London. We're going to continue to get fantastic interviews from her out of that event. I want to quickly check on markets, which are coming back to little change. And indeed, you can see the NASDAQ now flipping around to gains on this, the first day of October, the first day of a government shutdown in almost 7 years. Yields are coming down, and that may be one of the tailwinds. Right now, the U.S. 10-year yield is at 4.10.5, and we're looking at bigger drops at the front end of the curve. And then gold continues to hit new highs right now, $3,876 a troy ounce for the precious metal. This, though, as the dollar weakens. Let's get a look at some of the single stocks moving at this hour. Shares of Lithium Americas are rising after U.S. Energy Secretary Chris Wright confirmed widespread reports that the government was going to buy a stake. He says it's going to acquire a 5% stake in the company. As a result, Lithium Americas, which is a very small stock to begin with, continues to rise. That company, by the way, is got a market cap of just $1.6 billion. It was half that last week. Packaged foods company ConAgra also delivered a strong earnings report. Quarterly profit beat estimates despite the CEO seeing a cautious consumer, but investors are rewarding it nonetheless with a 3.3% gain in today's trade. And Nike reported better than expected revenue, signaling that turnaround efforts are starting to pay off as the company focuses on sports, including running and basketball. And this might be just one more area where the high-end consumer is helping to drive corporate profits higher. Let's dig into Nike earnings with Tesley Group senior research analyst Cristina Fernandez. She has a market perform rating on the stock, price target of $75. And what are we seeing here, Cristina? Is this indeed a turnaround? Is Nike able to sell, more of its $100+ shoes to consumers as the rich continue to spend?
Yeah, I think we're definitely seeing some green shoots. I think what was positive about the report last night was that every line item was a bit better than expected, and in the areas where they have been concentrated on, and that's been running, where they revamped the portfolio, North America, where they're making a lot of changes to their wholesale partners and the business they sell there. And that wholesale business was all deliver growth in the quarter. So I think we can, you can make the assumption that as they move that product portfolio revamp to other parts of the business and to other regions, then you could see similar results. And I think that was one of the things that was encouraging about the print like yesterday.
It strikes me that it's not just about shoes, right? This is a company that's selling, obviously, a lot more clothing. They sell a lot of equipment. They license the brand for a lot of products. What is the most exciting growth area for you, and what's the biggest problem still?
Yeah, I would say right now running is the most exciting. They talked about running being up 20%, and that's really where a lot of the new product has come in the past year. But the biggest challenge is on the sportswear side and the classic shoes. Over the past few years, they had really exceptional growth in franchises like Air Force One, Air Jordan 1, and Dunk. And those, the consumers moved away from those franchises, and they've done a lot of, they've been pulling units back a lot, and they have a lot of clearance to do. So that area is still weak, and they still talk about a lot of aggressive actions needing to happen on the Dunk shoe in particular. So that's where they need new trends to come in to the brand to attract consumers and new product.
I love those fuzzy Dunks that they sold in collaboration with the Grateful Dead, but I guess the young kids aren't looking for that these days. I wonder how important the U.S. is. Obviously, it's got to be their biggest market, but compared to a market like China, where they seem to be faltering, is that one of the biggest concerns?
Yeah, for sure. So the U.S. is, the biggest market. It's about 40% of sales, but China is, is pretty weak at the moment. It was down 10%. And the Chinese market historically was a very big growth driver for Nike. So to the extent that that market really suffers, will be a drag on the company. And there's some structural challenges they talked about in that market. The way they do business is different there. It's mostly stores run by third party. They don't have the factory stores that they can use to clear goods. So it will take some time. So there's definitely a challenge. And they also talked about some markets in Europe being a little bit weaker. So while there were a lot of positives, there were definitely a number of headwinds they call out on the call last night.
I guess tariffs have to be there in the headwinds, right? We were expecting $1 billion worth of costs from tariffs, and now it looks like it's going to be 50% more than that.
Yeah, no, for sure. So when they last reported back in June, the increase in the tariff rates that went into effect in August, they weren't known. So Nike sources a lot of products from Vietnam, from Cambodia, from Indonesia. So those tariffs went to about 20% from 10%. So that's a big headwind that they call out. And they said for this fiscal year on the gross margin, it's now going to be 120 basis points impact. It used to be 75. So that's definitely a drag. And overall, they talked about the profit outlook for their fiscal year 26 that ends in May being a bit weaker now because of tariffs, because promotions, than it was a couple of months ago. So I think although on the sales side, we're seeing momentum and they are taking steps to clear through a lot of the excess inventory, there are definitely some headwinds on the gross margin and profitability that are still there and will be a drag this year.
Yeah, they're still trading at 44 times expected earnings, and that's more than NVIDIA. Why do you think the market's willing to put such a high multiple on this stock?
Yeah, I think there's the expectation or I would say the possibility that Nike can really turn around the brand. And, they've done it before. Obviously, every situation's different. They're a bigger market now, and you could argue they were in a deeper hole. So the fact that if they could turn the sales around and get back to, let's say, mid to high single-digit growth, and also the profitability has been pretty low for them. Historically, Nike was a company that generated a double-digit operating margin in that mid-teens range. That's been a lot weaker now. So if you could get sales growing and profitability improve, particularly as they can reduce those clearance and promotions, then it could be a company that in a few years could be earning a lot more in EPS than they did this past fiscal year that just ended.
All right, Cristina, thanks so much for joining us today. Cristina Fernandez of the Tesley Group on Nike. The shares rallying about 5% today after the earnings impressed Wall Street. Coming up, RSM's chief economist says corporate confidence will drop the longer this shutdown lasts. Joe Brusuelas joins us next to explain. This is Bloomberg Open Interest. Breaking news coming down from the Supreme Court. The judges refused to let President Trump immediately fire Lisa Cook from the Fed. The Supreme Court says it will hear arguments on the Cook firing case in January, but for now, it won't allow the President of the United States to fire Lisa Cook for cause. And we'll continue to cover this case for you. Mike McKee is going to join us momentarily to talk about what this means. But let's talk to an economist right now who pays especially close attention to the Fed and all the members of the Board of Governors. Joe Brusuelas joins us, RSM chief economist and principal. And Joe, this is an interesting case because it goes to the heart of Fed independence and what the president can do to affect that. How concerned is the market that the Fed will lose that independence?
Well, I'm very, very concerned given what's gone on. There's been a real erosion of the Fed's independence, and the Scottish ruling actually should bolster market confidence that at least for now, this should slow down. But it's something that it's very clear that the president wants rates lower. He's appointed Stephen Mirren as a temporary appointment he's calling for, 150 basis points in cuts. So this is going to continue. But I do take some encouragement out of what we just got out of SCOTUS.
Michael McKee joins us now here at the desk, our international policy and economics correspondent. So, Mike, what do we know from the Supreme Court? This is a decision. It's only temporary until they hear the case in January.
Well, basically what it is without saying so directly, they're denying Donald Trump's request for a stay on the lower court decision that keeps her in her position. Basically, the Supreme Court is saying that the application is deferred pending an oral argument in January of 2026. So basically, they're saying you cannot fire her until we hear more in January of 2026. And so it looks like that case is going to go to the court. It doesn't say that they have granted cert here, but it does sound like they want to hear more about it.
It is a rare loss for the administration in front of this court. I think Greg Storr, our Supreme Court reporter, put out a story a few weeks ago saying at that point the Trump administration had either won or not lost 19 out of 21 shadow docket cases. So it is slightly surprising that they wouldn't allow him to do this.
Well, not as surprising, because they did carve out in the Wilcox case an exception for the Fed, saying it was a quasi-private organization that had a long tradition in the United States. And so there was some feeling that they might give the Federal Reserve a slightly different view in terms of the president's authority over the governors. They have not decided that authority yet, but they have put off a decision on it, which means, in effect, she keeps her job at least through January of 2026. And then I would imagine longer, because if they do oral arguments and grant certiorari and take the case, then it will go into the probably June or July release of the final orders by the court.
And just quickly, just to clarify, the Supreme Court remains open. The federal court system remains open for business amidst this shutdown.
That is correct. The Supreme Court is funded by non-appropriated funds and can keep operating because it doesn't need the essentially permission to spend money from the Congress. But the lower court systems do. They run similarly, but they do run out of money. It is possible that they will have to cut back on some of their activities, but that's down the road.
And the Fed, as you were telling me this morning as well, is self-funded, so they
stay open, and you don't have to worry about that.
All right, Michael McKee, our international policy and economics correspondent, you are in high demand. I see that radio wants you to report to the booth right away. Let's get back to Joe Brusuelas. He's with us, RSM chief economist and principal, initially booked to talk about the government shutdown and how that might affect jobs and the economy. But just one last comment on Lisa Cook and the Fed. It's interesting that the Trump administration wants to get her out of there, since she is dovish.
I know, that's the funniest thing about all of this, right? She would gladly support a rate cut and probably several rate cuts. But now what we've seen is that the introduction of Mirren into the Fed ecosystem, and I don't know about if you guys have read Fed rhetoric lately, there's been some very not so polite backhands to Mirren and his views from his co-Fed members. So it's very clear here that we're setting up for a period where it's going to be very contentious on the Fed. We're going to have multiple dissents, I think, over the next year as we move through this very interesting period in the most important monetary institution in the world.
Well, I mean, he thinks, or said that he thinks the neutral rate is closer to zero right now, even though we had a GDP print at 3.8%, right, and unemployment at 4.3%. If the neutral rate were at zero and the Fed is at 4, wouldn't that be very bad news for the economy?
Yeah, the economy would have tipped over and we'd be in financial crisis mode right now. Look, our star is not zero, right? Bring up TAYL on your Bloomberg terminal and look over at the left, and you create a user-defined estimate of the optimal interest rate. Put in 1.37, which is the Laubach-Williams two-sided test.
You put that in for your neutral rate?
That's my neutral rate.
I love this function, by the way. I play with it all the time.
Put 4.3 over there for NARU.
Okay.
And then return that, and watch what you get. What's the optimal interest rate, Matt, on the left-hand side?
Then I get...
make sure you use PCE as your basic metric.
I've got core PCE in there as my
okay, you want to use core
metric.
PCE? That's fine. So you should be, around 4.7, 4.9, something like that?
Yeah, I get... Actually, I get 4.3.
4.3. So what that tells you is maybe the Fed shouldn't be conducting another rate cut, which is very consistent with what we've heard from many of the members of the Federal Reserve. Now, I run 4 different models, right? Not a one of them are suggesting a rate cut right now. Yet that's likely what we're going to get, especially around the government shutdown.
Well, you can understand the concerns about labor, right? Because we've had a real slowdown in the non-farm payroll prints. We won't get those as long as the government shut down. But we are going to see 750,000 workers furloughed. 150,000 of them now are gone as of today because of their deferred resignations. So how does that affect the unemployment rate?
All right. So what that tells me is the unemployment rate's likely to move up to somewhere between 4.5 and 4.7 temporarily. And then when the workers go back, as long as we don't have mass firings, the unemployment rate will set back to 4.3. Look, I support a Greenspan-like risk management insurance cut. That makes sense given the current conditions. I mean, the political polarization is not unlike anything we've seen in our entire career arcs, Matt. So I get what the Fed's doing. But look, what about the medium to long term? Inflation's just rising. You know, I've come to the conclusion that the market is now assuming that the de facto inflation target is 3%.
Yeah, because 2%, we haven't gotten there since
It's been
the depths of COVID.
5 years.
Yeah.
If you look at the Fed's forecast, it implies 7 years. And I think that may be a bit optimistic. Markets are not static. They're dynamic. They're active. They're forward-looking. And they've moved on, right? Which is why, coming back to Lisa Cook, it's really important that we preserve as much of the Fed's instrumental independence as we can, because, you know, that's the road paved to hell. That's how we're going to get to 5, 6, or 7% inflation, is if their independence unwinds. That's why these SCOTUS decisions can move markets.
All right, Joe, great having you here with me on the desk. We have to, when you're not in Austin, when you're not in London, we have to keep getting you back on the show. Joe Brusuelas there, chief economist at RSM. As we head to the top of the hour, let's get a quick check on what's going on in markets. We have seen little change in equity indexes really since the open, and the yields continue to come down with the 10-year at 410.77. Coming up tomorrow, Veronica Willis of Wells Fargo and Cameron Dawson.